We all think of gold as the ultimate symbol of stability, but this week, that story got way more complicated. For centuries, when there is a crisis, investors flee to gold. That's why we call it a safe haven asset. But on Friday, prices slipped pretty sharply, down 1.3%. For gold, that's a big drop. So what gives? Why would the world's most famous safe haven suddenly take a tumble? Let's investigate. Okay, so it wasn't just one thing. 4 key factors all came together to push the price of gold down. We're talking a technical signal, the US dollar, bond yields, and some surprising news on the world stage. First up, the technical break. Gold had been in this nice, steady pattern called a rising channel. But on Friday, the price dropped right below the floor of that channel. That's a huge red flag for traders. Next up, the US dollar got stronger, and that's usually bad news for gold. Here's why. A strong dollar makes gold pricier for international buyers, which can really hit demand. Third thing on the list, US 10-year Treasury yields were climbing, hitting their highest point in over a week. And here's the key. Gold pays 0 interest. That creates what economists call an opportunity cost. I mean, think about it. Why hold something that pays nothing when government bonds are paying you more? And the fourth factor? Geopolitics. A surprise 3-week ceasefire was announced in the Middle East. See, when tensions ease, so does the need for a safe haven. That fear factor just disappears. Okay, so those are the short-term factors. But if we only look at that, we're missing the big picture. You have to zoom out. Despite this recent fall, gold is actually still up about 7% for the year. This shows long-term investors aren't spooked. They still see gold as a way to hedge their other bets. This all leads to the big question. What is gold's real job in today's market anyway? Lately, gold's been having a bit of an identity crisis. One week it's a shield, the next it's a speculative bet. This kind of whiplash is a playground for traders. But if you're investing for the long haul, it's just confusing. So what's the lesson in all this? Gold's recent moves teach every investor something really crucial. Instead of just reacting, smart investors take a breath. They ask, what's driving this and is it temporary? And that simple question, that's what separates a panic reaction from a solid, thought-out strategy. So maybe gold isn't just a metal. Maybe it's become a mirror, reflecting all our global uncertainty.
You know, for centuries, gold has been the one thing you could always count on. It's the ultimate financial anchor, the go-to safe haven. But lately, something's gone completely haywire.
I mean, that really says it all, doesn't it? The one asset people buy for its predictable, almost boring stability suddenly started bouncing around like some crazy new tech stock. It's like it had a total identity crisis.
So yeah, that's the big question, right? What on earth could possibly break gold? Well, today, we're going to dig in, decode all this chaos, and figure out exactly why investors started hitting the sell button so hard.
All right, so to really get to the bottom of this, we have to start here. Gold itself seems to be having a major identity crisis. One minute it's the solid shield against inflation, and the next it's getting tossed around by every little whisper in the market.
This analogy is just perfect. Imagine buying this big, heavy, unmovable safe for all your most important stuff, only to realize it's been put on skateboard wheels and could just roll away at any moment. That complete loss of control, that's the feeling that's fueling this panic.
So how did this chain reaction even start? Well, it all kicked off with a single, very specific event. We have to zoom in on the exact moment the market's internal structure just buckled.
Okay, so a 1.3% drop, that doesn't really sound like the end of the world, right? But here's the thing. This was never about the size of the fall. It was about what it broke on the way down. It completely shattered a super important technical line in the sand.
And that structure is something traders call a rising channel. Just picture 2 parallel lines sloping upwards on a chart, and the price just kind of bounces safely between them. The thing is, these aren't just lines on a screen. For automated trading programs, they are digital tripwires.
I love this way of thinking about it. It's just like a bowling alley when you have the bumpers up. As long as the ball is bouncing between those bumpers, you know you're headed in the right direction. And for a while, investors felt really safe inside that channel.
But on Friday, the ball didn't just bounce. It smashed right through the bottom bumper and went straight into the gutter. And the instant that happened, it wasn't human panic that took over. Oh no, it was the algorithms. That technical break triggered a massive, pre-programmed wave of automated selling from the machines.
But here's the thing, a support line like that doesn't just snap in a vacuum. Something has to be pushing on it.
And in this case, there were two huge financial forces, like giant gravity wells, pulling money and energy away from gold, creating a perfect storm.
And those two forces were one, a super strong US dollar, which makes gold more expensive for anyone buying with other currencies, and two, and this is arguably the more powerful one, rising interest rates, or yields, on US government bonds.
And this brings us to the real engine behind the sell-off: opportunity cost. See, gold just sits there. It's a rock. It doesn't pay you any interest, no dividends, nothing. So when risk-free government bonds suddenly start offering a really nice, guaranteed income, well, the entire calculation for big money investors changes overnight.
Seriously, think about it. Why would you keep your money buried in the backyard where it earns nothing when the government is offering to pay you just for holding it? Now imagine you're a pension fund with billions of dollars. You're going to take that guaranteed income. And when they all do it at once, that capital rotating out puts incredible pressure on gold.
But there was a third factor at play, and this one had nothing to do with charts or math. This was all about human emotion. While the dollar and bonds were pulling money out, a breaking news story suddenly evaporated the main psychological reason gold was so high to begin with.
And that news was a ceasefire. See, when things are scary in the world, investors pay what's called a fear premium for gold. It's like portfolio insurance. But when that ceasefire was announced, the market collectively looked at its insurance bill and thought, hey, why am I paying for hurricane insurance when the storm just got downgraded?
And that is when things got really ugly. All the speculators who had borrowed tons of money to bet on more fear and anxiety were suddenly caught on the wrong side of the trade. They got margin calls, which forced their brokers to just dump their positions at any price, which then pushed prices even lower, triggering more selling. It was a vicious cycle.
Okay, let's take a breath. So we have a broken chart, robots selling, two huge macro forces, and a leverage-fueled flushout. That sounds like an absolute terminal freefall, doesn't it? But if you pull the camera back a little, the data tells a really different, kind of surprising story.
Yeah, it looks like a total disaster. But what if it's not the whole picture? Get this, after all that chaos, all that selling, gold is still up about 7% for the year. 7%. That tells you that underneath all this short-term noise, the foundation for gold is actually way stronger than you'd think.
And that foundation is basically held up by three giant pillars. First, inflation is still stubbornly high around the world. Second, there are real long-term worries about the value of regular currencies. And maybe most importantly, the world's central banks are still buying gold like crazy. They're not trading the headlines, they're playing the long game.
So what can we take away from all this? If you boil everything we've talked about down to one single lesson, it's all about changing how you think about these crazy market swings. The real key is to shift the question you ask. Instead of that first emotional reaction of, oh my gosh, should I panic and sell, you train yourself to ask a more diagnostic question. Okay, what specific mechanics are causing this? It's all about looking past the flashing red numbers on the screen and trying to understand the invisible gears turning underneath it all. When you understand the why, you're way less likely to get run over by the what.
And that leaves us with one last kind of mind-bending thought to chew on. So much of gold's value comes from the fact that big institutions, especially central banks, trust it. But as we head deeper into this new digital tokenized world, what happens if they decide they don't need a shiny metal anymore? If that ultimate anchor of trust just disappears, what's anything really worth?